Thank you. Let's see. Okay, well, thanks so much for having me. I'm excited to present this paper because I'm all nervous too, because it's a very new paper that Eric and I have been working on over the summer. And we had a brown bag at Emory, but this is really the first time we're getting formal feedback. So I'm excited to get your feedback on it. The title of the paper is Institutional Investor Preferences and Analyst Information Production. And let me move on. The basic research question is, does institutional investor horizon affect analyst information production and the information content of security prices? And basically, it's based on sort of the notion of the Keynes beauty contest, where Keynes sort of compared professional investors into entrants into a beauty contest, and where the winners would be selected based on whether they picked the most popular photo. And so Keynes said, well, the most sophisticated contestants wouldn't base their opinions on their assessment of beauty, but rather what they expected the assessment to be of others. And so this was important because it sort of brought about this notion of beliefs about beliefs, or higher order beliefs. So I don't care about my opinion, I care about what other people's opinions would be. And this became important in investing models because it suggests that some investors, like short horizon investors in particular, care more about the expectations of others because that will determine the price in the near term, and less about longer term fundamentals because it won't matter in the near term prices. And so this higher order belief model in investing is sort of recognizing that there's these short-term investors who really care about the short term and what prices are going to happen in the short term, and less about the fundamentals in the long run. And there's been empirical research that sort of supports this short-term investment beliefs about beliefs. And research has shown that short-term investors do seem to trade on near-term strategies. So if there's a lot more short-term investors, their sales predict breaks in earnings strings 1 quarter ahead. They also try to exploit the post-earnings announcement drift in the next quarter. And they experience lower accrual mispricing if there's more short-term investors in a company. So there's evidence that short-term investors do tend to care about sort of near-term prices and less about long-term fundamentals. So research has shown that there's profitability of longer-term fundamentals-based strategy. The profitability is higher if there's more short-term ownership. And even the near-term momentum and reversal is stronger for stocks with short-term investors. And so the evidence is sort of consistent with this beliefs about beliefs, and short-term investors care more about the price changes in the near term. And so given that there's these short-term investors that care more about the near term, our research question is, does this institutional investor horizon affect what information the analysts produce in terms of short-term versus long-term forecasts? And we feel like this is a reasonable hypothesis because prior research suggests that analysts face significant time and resource constraints, so they can't just produce, everything for everyone. And they have incentives to produce forecasts that are consistent with their institutional client preferences. There's been survey evidence that says that client demand is an important determinant of what companies analysts cover, and that analysts try to be responsive to institutional clients. And so this evidence suggests that, yeah, analysts are going to respond to what the institutions prefer. And archival evidence shows that fund manager rankings is actually a really important determinant of analyst compensation. So given the constraints that they have, and given the incentives they are to sort of cater to the preferences of institutional investors, to us it seems reasonable that sell-side analysts would produce more near-term forecasts when the institutional investor horizon is shorter. So that's our first hypothesis. We do think, however, there are arguments for the null. Basically, it isn't all about near-term fundamentals, right? And we know that even news about long-term fundamentals can affect near-term prices. So it's not like institutional investors don't care at all about fundamentals in the long run. And analysts have a lot of other activities and tasks besides issuing forecasts that are going to influence client preferences. So we do think there's a credible null. Our next hypothesis is that we think this could affect the information content of prices. So this beliefs about beliefs, the higher order belief theory, predicts that short-term investors are going to react more strongly to disclosed information in the short run and underweight their private information because they care about others' expectations and instead of their own. And so you would think that this would affect their trading and it would affect the information that's incorporated into prices. And we know that analyst forecasts contribute to information and security prices. And so if they're focused on the near term instead of the long term, that could affect the informativeness of prices. So we think both the institutional investor horizon and the analyst production of near term versus long term forecasts could affect the information content of prices. So that's our second hypothesis, that current stock returns impound less information about future earnings when institutional investor horizons are shorter and when analysts produce relatively more near-term forecasts. So in terms of our proxy for investor horizon, we use the institutional investor portfolio turnover or their churn rate for each quarter and each institution. So for each institution in each quarter, we say, how often are they churning? Are they turning over in their portfolio? So we measure each institution's trading horizon as the average churn ratio in the previous 12 quarters. So this is the institution, not just in this firm, but overall the institution's churn rate. And then what we do is we average the churn rate of the institutional investors holding this stock by using the ownership weights closest to the end of the fiscal year. So we're using the 12 quarters before to get the churn rate for each institution, weighting it in terms of the ownership in that firm to get the institutional ownership turnover. And we use the annual lagged change in turnover. So the change in institutional ownership turnover, this churn rate in T-1, we're going to see if that affects the analyst near-term forecasts in year T. In terms of our proxy for near-term forecasts, we calculate this ratio of the number of current year annual EPS forecasts divided by the sum of the current year T+1, T+2, and long-term growth forecasts. And we get this using a consensus file at the end of the third month after the fiscal year end. So we're looking to see how much of these forecasts are current year relative to in the long run. So here's our descriptive statistics. We go from 1983 to 2015, and you'll see the near-term forecast ratio, the median is 50%. So like 50% are current versus long-term. And you'll see the institutional ownership turnover is about 0.288. So they turn over about 56% a year. In terms of our research design, we run this near-term forecast ratio, the analyst forecast near-term forecast ratio on controls and the change in the institutional ownership turnover in T-1. So we predict beta 1 to be significantly positive. We control for a lot of factors that should be related to forecasting and to institutional ownership. So the level of institutional ownership, profitability, market value, book to market, growth, forecast dispersion. We also control for the management's near-term forecast ratio. So what is the management doing in terms of their forecast and if they issued a new forecast during the year. So we also control for what the management is doing in terms of forecasting as well. So table 3 is our main result. And so the first column, we exclude analyst following because it's sort of mechanically related. In the second and third and fourth, we include the analyst following. We have either year fixed effects and industry fixed effects, the year-end industry interacted fixed effects, and then the last column, we do the first difference of the near-term forecast ratio. And in all of the specifications, we find a significant positive relation between the change in the institutional ownership turnover ratio and the analyst near-term forecast ratio. So there does seem to be a relation between the turnover and what the analysts are doing. And even with the change specification as well in column 4. In table 4, we look at an alternative proxy for analyst forecast production and focus on quarterly forecasts instead of the annual. So our proxy for a sort of near term is the quarterly earnings per share forecast they have this year relative to the number of quarterly earnings per share forecasts they had in the prior year. And so that's a different way to capture this near-term ratio. And again, we find in all the specifications a significant positive relation between the institutional ownership turnover and the issuance of more near-term forecasts by the analysts. We also try an alternative proxy for institutional horizon. So instead of using this churn ratio, we rely on the Boucher measures in terms of transient ownership, dedicated ownership, and quasi-indexer. And so the first column, our measure is going to be the net transient. So the percentage change in transient minus the percentage change in dedicated and quasi. And we find a significant positive relation between that and the near-term forecasts that the analysts provide. In the second column, we just look at the increase or the change in the transient ownership percentage, find a significant positive relation. And the third column, we look at just the percentage change in dedicated and quasi-indexer, which would be longer run horizon, and we find a significant negative relation. So this alternative proxy is also consistent with the horizon being associated with the near-term forecast the analysts provide. Well, we recognize that in terms of institutional ownership and institutional horizon and analyst forecasting, that there's some, endogeneity. So we also tried a matched design. In the matched design, we look at terciles of the institutional ownership turnover, and we use an indicator variable for high. And we first do propensity score matching based on all the control variables as to whether they will have a high institutional ownership turnover, be in that high tercile. And we do matching on that. We also do entropy balancing, and we still find that these high change in institutional ownership firms have a higher near-term forecast ratio for the analysts. So it holds with respect to PSM and entropy balancing. To try to get even better identification, given that we know this is an issue, we tried to look at sort of something that's more exogenous in determining whether a company has a longer term or short-term investor horizon. And so we looked at the addition to the Russell 2000 from below. And so we're looking to see companies that were first added to the Russell 2000 from below in T-1.
Did we lose Terry? Sorry, everyone, we might have lost Terry. She may phone in if there's an issue with the connection. Sorry, everybody, about this. Yeah, let's pause the recording.
Do this, Russell. We do the Russell 2000 edition, but we also do the PSM matching and the entropy balancing. in terms of whether or not a company is added to the Russell 2000 based on the control variables. And even with the PSM and entropy balancing, we find a significant negative relation between addition to the Russell 2000 and the near-term forecast ratio, again suggesting when you're added, your investor horizon is longer, and that's negatively related to the analysts issuing more near-term forecasts. The last
Sorry, Teri.
Sorry
to interrupt. Is the screen sharing working for you?
Can you not see it?
We cannot.
Okay, let me get back here.
Oh, yeah, something is starting to load.
Can you see it now?
Looks like we're in business.
Very good.
Okay, good. Sorry about that. The last sort of identification test we do is brokerage mergers. So here we feel like this has nothing to do with the firm if a company is, if it's institutional investors are merging. So we find 30 institutional investor mergers over a period. And what we do is we look at the change in the horizon because of the merger. And so the acquires versus takes the target. And so the horizon changes. And so we have this treatment that captures the change in the institutional investors horizon from the merger. And then we have post for after the merger. And we find a significant positive relation with that interaction and the near-term forecast ratio. So when there's this merger and the institutional investors horizon gets shorter, which has nothing to do with the firm because it's just a merger of the institutional investors, the analysts issue more near-term forecasts the next period. So we think it's pretty convincing evidence that there does seem to be an association between the institutional investor horizon and the horizon of the forecast that the analysts provide. And our second research question, we want to know, does this affect the informativeness of prices? And so we run returns on future earnings, and we have indicator variables interacted for the change in institutional ownership turnover. So if there's more institutional ownership turnover, sort of a shorter horizon, then that means that prices should have less of future earnings information in them. And then we do the same thing with the near-term forecasts offered by the analysts. So if analysts have more near-term forecasts, then there should be less information in prices about future earnings. We control for everything. And so our table 8 has the main result. You'll see that in terms of the institutional ownership turnover, we find a significant negative relation between interacted with that and future earnings. So when there's greater institutional ownership turnover, there's less information about future earnings and prices. And then when you do the near-term forecast ratio, even after controlling for the institutional ownership turnover, we find a significant negative relation between that and future earnings. So less information is incorporated in prices about future earnings when there's more near-term forecasts. And this holds in the 3-year FERC as well, not just the 1 year. And just to make sure this isn't driven by these firms with shorter horizons having less persistent earnings, and that's why you see prices are less informative about future earnings, we run the regression with about future earnings on earnings, and we don't find any relation. So it doesn't seem to be related to the persistence. And so we think that this whole Keynes beliefs about beliefs suggest that there are investors who care more about near-term price movements and less about long-term fundamentals. And we think that given these investors, analysts are more likely to cater to them and so provide more near-term forecasts instead of long-term forecasts. And so we find evidence consistent with this. We find a positive association between the prior year change in institutional turnover and the analyst's relative production of near-term forecasts. And the informativeness of stock prices for future earnings is diminished both when the investor horizon is shorter and there's more near-term forecasts. So we think this is informative because it does provide information in terms of analyst decision processes. What are they doing, and given their constraints, are they catering to the needs of institutional investors? And I also think it's important in terms of this higher order belief theory, because it seems to be focused on the investors, right? The investors have the short-term focus. And what we're suggesting is even broader than that, because it influences what the analysts do as well and the public information that's provided to the market. So we think that it provides interesting insights, and we think the evidence is convincing, but of course we do. So thank you. Ready for questions?
Yeah, thank you. You could probably just keep the screen shared in case people have questions that you have to go back and forth to results or anything like that. All right, so I think the first comment was Francine.
Yes, I was just asking, when you speak of fundamentals, are you talking about, in particular, fundamentals or information that the analysts are talking about? Are you talking about non-GAAP metrics and the non-GAAP information that gets communicated? Because most of the analysts' forecasts are non-GAAP oriented, not GAAP oriented. Or are you talking about real fundamentals, GAAP fundamentals?
So I think when we're thinking about fundamentals, we're thinking about sort of the valuation inputs to value the company. So earnings and book values. And so you use the investors use the analyst forecast as inputs into valuation. And we're more thinking about longer term versus shorter term. So if you're trying to value a company, you care not just about what's happening next quarter or next year, but what are the long-term growth, so you can put it in your valuation model to come up with firm value. So whether it's non-GAAP, I guess we're indifferent as to whether it's GAAP or non-GAAP, and more about the horizon that's relevant for firm value.
I would just, and I can contact you separately, but I would not be indifferent between non-GAAP and GAAP, because I've seen significant manipulation of non-GAAP metrics that end up being completely divorced from the GAAP reality, and people are plugging that information into models, and it never gets reconciled. It never comes back to reality. So if you're,
and what we can, yeah, what we can do is, given that, oftentimes they have GAAP and non-GAAP forecasts, we could see, does it matter, does GAAP versus non-GAAP, in addition to short-term versus long-term, matter given the client preferences? So I think that's a great idea. We can look into that.
There's some other research that speaks to the difference between analysts focusing on non-GAAP versus GAAP. And I can send you some practical examples on where that gets divorced.
Yeah, no, I do think that that's an important issue in terms of GAAP versus non-GAAP. We weren't really focusing on that for this study. We were thinking more short-term versus long-term, but I also think that's just as interesting, and we could incorporate that as well.
Okay.
We can look into that.
Excellent. I think next we have Christina.
Hi, Teri. Thanks for joining our webinar series. It's great to have you here.
Me.
Yeah, so I have a question, like more general. What drives investor horizon? And let me give you an example, like recent speech or letter to investors by Larry Fink, right? Triggered a lot of discussion about the focus on long-term, focus on environmental, social, governance issues, and so on. And I'm sure that following that, we'll have a lot more focus in terms of analyst forecasts, in terms of investors revising their strategies, and so on. So my question is, like, for the purposes of your paper, do you just take investor horizon as given, or you might want maybe to provide some some light on what drives that investor horizon, because it's not constant over time, right?
Right. And so you're right. We sort of have the investor horizon as given. But I do think that, you're talking about ESG, and if institutional investors are also concerned about that, then that might also affect what the analysts provide in terms of production of information. So we're sort of taking the institutional investors, for whatever reason, have preferences. And it might be because of their clients. It might be because of, whatever funds, what they want to be known for, what they want to provide their clients. But given that the analysts are going to cater to what those institutional investors want. But I do think we could, I think that's a different, deeper question,
right.
That, prior literature has looked a little bit into, but I think there's a lot more to understand what creates institutional investor horizon or interest in ESG, or,
right.
What drives what institutions do. But you're right, we're taking that as given right now.
Okay, thank you.
And this is sort of exogenous to the analyst.
Thanks.
But I do think it is interesting that, it isn't just horizon. It could be other things like environmental issues, and there might be pressure from the institutions to analysts to provide other kinds of information as well.
Right, or regulators or some other, sources.
Exactly.
Okay, thank you.
All right. So next up, we have Stephanie.
Hey there. Thank you, Miami, for featuring an analyst paper. Teri, good to see you again. I wanted to ask you, you focus a lot on investors who are long on the stock, and I wanted to ask you what the role is of short sellers. And I think there may be a role, but I also think there's evidence, or sort of my understanding anyways, is that to the extent that you have these passive, sort of low turnover investors, to the extent that there is interest in short selling, it's that much easier to short sell because you can borrow the stock from them. So.
Right. And we thought about that, and so I think it's less clear what the analyst role is for short sellers as opposed, at least in our minds, we couldn't really think through, like, usually the short sellers, they're doing their own research, or they're countering, but I don't know that they're relying on analyst forecasts as much. And I don't know that analysts would really be catering to the short sellers. So we were more thinking, I think you're right, we were more thinking long institutional investors, and short sellers do something else and rely on different information, and analysts aren't catering to them. We might be wrong, but at least and you would know way better than I would, in terms of our knowledge of it and anecdotes, we couldn't put the link as clearly between short sellers and their needs, and that analysts would respond to those. But
yeah.
Do you know that maybe there is a link, and we should consider
There's a
that
little
as well?
bit of literature on kind of analysts and hedge funds, not too much about me. I might be missing something about short selling, but it seems to me they've got to play some kind of role. It's hard to know just what they want, as you say. Do they want shorter term or longer term focus, or something else entirely? But my fear is that by, I'll be critical, ignoring them, that you might be missing a piece.
Yeah. So do you think that controlling for short interest, or do you think we should also sort of see if short interest affects their production as well?
I'm willing to believe that short interest could affect their production, but at minimum, it seems like controlling for it would be a start. I'm willing to believe that they could play a role, though.
Do that. Yeah, we did. You're right. We ignored it.
All right.
Thank you. We'll definitely do that.
So we have Rahman.
Yes, thanks, Teri. Great presentation. I think it's a very simple idea, very easy to follow. Some good tests. And speaking of tests, right? One thing I was thinking when you kind of presented the front part of the paper is it possible that when you have a firm, and maybe it's something that Christina was trying to ask, at least in a similar vein, is it possible when you have a firm that has this a lot of short-term investors. And basically, the reason why I have these short-term investors is, just difficult to predict what will happen in the long term. And maybe that's why, the analysts are more likely to issue short-term forecasts. And I know that, your later test, help with all of this, but still I wonder that, if you were just to look at the analysts and their long-term forecasts, is there a difference in accuracy between, firms with more investors and less? I just wonder that. There's some mechanical relation.
I think that's a great point. Yeah, no, we haven't looked into that, but we could definitely, because if it is that the ones with short term, they're providing more near-term forecasts because they're too hard to forecast the longer ones. So it might have nothing to do with client preferences. It might have to do with just ability. So we can definitely do that test and see, is there a difference between the forecast ability for the ones that are more near-term versus long-term in terms of the errors, and see if there's a systematic relation. I think that could be an alternative explanation that we could definitely test for.
Thank you.
We hadn't thought about doing, because we were trying to do this exogenous, stay away from the firm, but we hadn't really done much in terms of the analysts' errors and ability to forecast near term versus long term. We can definitely do that.
Right. Thank you.
Next we have Daniele. Yeah.
Hi, Teri. Good to see you, and thanks for the presentation.
Hi.
I think the story is very interesting. I'm very interested in these horizon studies. I have just a very quick question about the strategy that you use related to the Russell 2000 index assignment. So do you use, I'm asking just because during that part of your presentation, you lost the connection, so I didn't follow it quite well. But are you using an instrument in that case to sort of randomly assign firms or generate variation into index fund ownership?
So we were looking as to whether the firm was added to the Russell 2000 from below. And then what we did is we did PSM and entropy balancing for characteristics that firms that are similar but weren't added to the 2000. So we did just the Russell 2000 from below, and then we also did PSM and entropy balancing to do some matching across them, and then used that as sort of the change in institutional ownership instrument, and then did the relation. So we did it both.
The thing that you're trying to capture there, I think it's related to passive versus active ownership, right? So, I mean, I guess my question is your assumption that an index fund, so a passive institution, has a longer horizon than an active institution, and the Russell 2000 can sort of create that variation?
Exactly. So our underlying assertion is that when you're added to the 2000, the horizon will get longer of your institutional investors because of more index funds. And so we use that as the instrument. And then we do find a significant negative relation between adding to the 2000 and the change in institutional ownership turnover.
Okay, thank you.
Mm-hmm.
Actually, let me ask a quick related question, then we'll get to Oliver. Apologies, Oliver. Just with that assumption, and I mean, even Daniele would probably have an opinion on this for sure. When I think of these index funds, they might be, I guess, longer term in focus, say we buy that, but then how does that sort of translate to a demand for analyst information? In the sense that if they're just simply tracking what the indices do they have a need to even look at analyst reports or even have a care for the fundamentals if they're just literally going to track an index?
Yeah, and so I guess we're more thinking that there'd be less near-term focus. And so if it's in an index, then you don't really care so much about what next quarter's earnings are going to be. And so it was more, not so much about there's more passive and they care about the long term because they're doing valuation, but there's less demand for near term. So we were sort of thinking it the opposite way. Because of the being in the index, you're not going to be following each quarter as much to see what's going to happen to prices because they're just in the index. Does that make sense?
So, yeah. So it's not necessarily that they're going to demand more longer term information from the analysts. It's just that you're going to see a drop in the demand for the short term.
Less demand.
Cool.
Right. I think that's the way we thought about it.
Yeah. All right. Apologies. Oliver?
Hey, Terry. Thanks for a nice presentation. So I just have a question about how you thought about kind of the channel of causality here, and like a bit like in broader terms, so more from like a general equilibrium perspective. So when these analysts are pressured by fund managers, are they then also exerting pressure on management by being more short-term focused? So does it have any real effects on managers' decision making? And then when managers become more short-term oriented because of the chain of pressure, basically, what implications then has that again on other analysts or even the analysts of the same firm? Is there like some kind of circle going on there that then perpetuates, or how do you think about that?
So we looked into the management sort of near-term forecasts provision. And so we first looked to see if there's greater short-term focus of the institutional owners, is that associated with more management near-term forecasts? And we found no association at all. So we don't see that this institutional ownership horizon is affecting the management's horizon in their forecasts. But then what we did is we also controlled for that to see, does that affect what analysts do? And we do find in, let's see if we look at table 4, we do find that some evidence that analysts, when managers have more short-term focus, then it could affect the analysts' near-term focus as well. But we find incremental to that, the institutional ownership horizon matters. So we tried to deal with the management. We just didn't find evidence that the institutional ownership affects their forecasting horizon. But then you were asking about the analysts, and is there pressure from the analysts? What was the second part of your question? Sorry.
The consequence of that would be then, if managers were to become more myopic, which you don't find. So I guess at that point, the chain of causality were broken. Then, what effect would that have? Right. But no, totally agree with you. Thank you.
Yeah, we don't find any evidence that there's an association between the change in institutional ownership horizon and the management forecast horizon. So.
Thanks. I think Shagata wanted to ask a follow-up to that, and I think Francine as well. So
yeah, I'll just, I think what Oliver is raising is a very cool thing that you might want to think about, Terry, because I wouldn't think of this as something you control for. There may be something worth examining here in terms of, and I saw that Emmanuel has some of this wording in his next question, but it's about this reinforcing loop between analysts and investors. So analysts cater to investors and sort of almost reinforce a short-term focus, and managers often will blame their own myopia on short-term targets and the importance of short-term targets, right? And so, right. So it would be a cool angle for you to investigate. I almost think of it as something you don't necessarily want to control for. Now, it doesn't. You said you controlled for managers' own forecasts. But I think the key part of Oliver's questions is their actions, right? Like, are they doing anything differently in their real decisions that caters towards meeting short-term goals, because that's what everybody is interested in, and maybe there is some long-term consequence of this for the firm. That's all I sort of wanted to say.
Okay, so what we sort of did is we said, start with institutional ownership horizon. It doesn't seem to affect management forecast horizon, but it does affect analyst forecast horizon. But then what we haven't done is then say, well, how does the increase in analyst forecast horizon, maybe that has a lagged effect on management forecasts and on their real decisions. And we haven't done that link. We can definitely do that. It would be sort of another outcome like price informativeness. This is the outcome of the analysts having a shorter horizon. I think that's a great idea. We can definitely do that.
Yep.
Francine, I think you had a point.
We'll do it.
Just to reinforce that idea, what Oliver said, in my experience in the last 5 years, looking at a very turbulent time in terms of changes in accounting standards and also the Tax Reform Act and now COVID, you have very specific events that are changing people's time horizons in terms of how far out they can go in predicting or looking at or giving information about certain metrics. So, I mean, when I looked at the feedback loop from a reporting perspective, it was between management and the analysts. In other words, analysts may be looking to management to report on certain information so that they can then keep feeding their models and then create new forecasts. However, management wants to report against what the analysts are predicting in terms of guidance or estimates. And so there's this feedback loop in terms of, you know, what's going to happen when revenue recognition comes in January of 2018? What's going to happen when tax reform comes? What's going to happen when the new leasing standard comes? And so you have some very specific events where we saw as reporters, the time horizon shrunk significantly in terms of what people were willing to report. So management was unwilling to report out farther because they did not want to predict yet the impact of, let's say, new revenue recognition rules. They hadn't done those calculations or that analysis yet. People were not sure what the impact of tax reform was going to be, so they could not predict out what was going on. So then the analysts would shorten up how far out their guidance would go, and then management would report against what the analysts were willing to put out there as estimates. And it was this feedback loop in terms of even defining the metrics, because management couldn't go out too far because there were significant changes in how certain things were going to be reported or accounted for. And analysts were starved from information from management, and then they couldn't produce models. So then management didn't report against metrics that the analysts didn't have to predict on. It was, and again, we saw really bad situations where, for example, analysts would continue to report on ASC 605, even after 606 was implemented, because they did not want to update their models. And so management was forced to report under old 605 numbers, and they got in trouble from the SEC because they were continuing that way too long. They were continuing to put out numbers under 605 because the analysts kept putting out numbers under 605 because they didn't want to update their models, because they didn't know how to, in other words, and it was dependent on whether the impact was positive or negative to the company, whether they stayed on the old model or whether they updated their models. I mean, I could give you lots of examples, but the point was when there was uncertainty about the impact of a significant change, like revenue recognition or leasing or the Tax Reform Act or now COVID, the time horizons shortened quite a bit. And for me, it was a feedback loop between companies and analysts who are working together to produce information that impacts the stock price on earnings day. The end.
So this is like, so I can see, we can look to see events where there's more uncertainty and more short run and managers are having difficulty. And this would be more the second part of the paper that we'd be adding in terms of the ramifications, the relation between analysts and managers, not necessarily the investors' effect on the analysts. So it'd be sort of this additional analyses, whether it's sort of exacerbated when there's issues with the terms of short run uncertainty. We could definitely do that. Consider that as we do these additional tests in the relation between analysts and managers. I will make sure we do that.
I'll forward you some information about all of this separately.
Awesome, thank you. So it seems like there seems to be an appetite for sort of going further beyond the price informativeness and looking at how managers react to the analysts as well. Okay, we can definitely do that.
All right, thanks. So I have kind of two somewhat related questions, but we've also flushed out a little bit of this stuff in the discussion we just had. So the first one was, do you think, what was your take on is it a change in the institutional investor horizon that just changes for whatever reason that's driving this and the analysts are responding to that? Or is it sort of an initial change in management outlook and the way they approach things, which then attracts, so if management take a more long-term horizon, they'll attract longer-term investors. If they take a more short-term horizon, again, for whatever reason, they'll attract those type of investors. And then you see the analysts like responding to that. So I just kind of wondered where you see the causal change starting.
So we were thinking the causal change started with the institutional ownership, and that's why we did that merger, the institutional merger, because this has nothing to do with the firms, right? And so that's where we're like, this is where this is showing it has to do with the institutional horizon, nothing to do with what the managers are doing or the firm is doing. But so that makes us sort of more comfortable that we can make that assessment. But that's not to say that there's something that it also happens that managers do something that affect what the institutions do, and then that affects what the analysts do. But we sort of take that as the given. But we could also, we were more interested in the institution. Did that affect managers? And we found no relation. But we could go before that and say, what are managers doing? Does that affect institutions? Then it doesn't affect managers, but it affects analysts. So we could keep going backwards and see if we can find out, even though, you know, these mergers we think are pretty clear evidence has nothing to do with what the firm or the managers are doing, but that doesn't necessarily mean that's true, you know, more broadly. So we could also investigate further back and see, you know, what does create. I guess we just thought, you know, given the literature on institutional investor horizon, we'll take that as given, because that would be a pretty big endeavor to try to understand that before we start understanding how analysts respond. But I think it's an interesting question that I think we should address, and we will look into it. I just don't know whether it's something we want to put in this paper, because we're taking it as given.
I mean, a great thing, and again, I don't know the literature all that well, so this could not be a great way to do it. But if you just look at a CEO change or management change, and then somehow sort of measure whether this CEO, perhaps at their previous job, took a more short-term, long-term view, that might be one way to capture that change in the management outlook, and then see from that. So the other quick question, this is more just your opinion. Yeah, this is more just your opinion on something that I've always been interested in. So if you do have this I wonder if the loop is somewhat reinforcing. So more short-term, so you've got short-term investor base, there's a change, it goes to more short-term investor outlook. Analysts then respond, right? Cater with more short-term forecasts. My guess is in the next period, take this out to period 2, that brings in more short-term investors, and then you have this feedback. So I kind of wonder, and you know, if you're to believe some of the arguments made by even in academics and financial press, this is not necessarily a good thing. So we want to encourage the long-term view. So if it is this reinforcing, how do you view that the cycle could be broken? And is this maybe where there's a need for regulation, because it's unclear how you're sort of going to break this self-reinforcing loop?
I guess in my mind, and this is just me speaking without spending a lot of time thinking about it, but I guess I do think it is something that would be reinforcing. And if analysts are more short-term and they don't have the long-term forecast that the longer-term investors need, then it might affect even more so what institutions and kinds of traders. And so I do think that it could sort of snowball because of that. And maybe there should be some sort of regulation about long-term, short-term, something in order to make us up, unless somehow in the market there's competition and there's mispricing, and so the arbitrageurs will come in and get the long-term information and exploit it. And so I think it will create sort of this mispricing and more arbitrage opportunities for those that are more long-term focused. And maybe that will just, the market itself will correct it. And, you know, I don't know that you can regulate what analysts do in what they produce, or so hopefully there's a market correction, and those of us that are doing long-term investing and long-term valuations and care about the long-term maybe can arbitrage this away eventually.
I mean, the constraint there would be if you can, you know, hold the position long enough to see the price go to the fundamentals.
Exactly.
Right? That's always the friction.
Problem.
Yeah, that's always the cost of arbitrage can be such that you're just not going to get that. All right, we've got a couple of questions finish up. So Rosie.
Hi, Terry. Thank you for the very nice presentation. So I'm wondering whether you could provide us some institutional backgrounds about how likely that the institutional investors are also the clients of the analyst brokerage house. So kind of relatedly, do you think that the analysts would care about the horizons of the investors that are not the client of their brokerage houses?
I think at least there's been survey evidence that they do care about, and they do care about their rankings. And so I don't know if it's just at the margin, but I do think the survey evidence and even the archival evidence suggests that they care about these things. They care about the institutional investors, even if like they're not necessarily the clients, they care about their rankings. So I do, that is our assertion. And so I guess it would bias us against finding anything if it weren't true, right?
Okay, thank you.
Thanks. I think given the time, this might be the last question. We're going to have Anthony.
Hi, Terry. So I was just wondering, you know, if analysts are kind of altering their forecasting behavior to cater to the horizon of the firm's institutional investors, do you also see complementary changes in other aspects of their information production? Like when you're looking at their target prices, their recommendations, do those shift away from long-term fundamentals?
So I think that's an interesting question, and we haven't looked at that, but that is something on our to-do list, is like, what other activities, you know, because they have constraints on their time, if they're doing more short-term forecasts, you know, what gives? And so I do think an extension would be to see, you know, what's being given up and what are they doing less of besides just long-term forecasts, right? Are they doing something different with their target prices and even the characteristics of their forecasts? And so it's not just what they're spending their time on, short-term versus long-term, but also the characteristics of their forecasts themselves. So I think that's something that would be interesting to look into as well. We didn't get to it so far, given this is an early draft, but I do think it's an interesting question that we should look into.
Thanks.
All right.
Thank you so much for all the feedback. This is really helpful. It's been, it would be great to go back and work on it.
Excellent. So yeah, big thank you to Terry for presenting. Big thank you to all of you for participating in this. Terry, you'll see the video of this will be available, but we can also send you a transcript of the questions. If anyone else has a question that you didn't get to ask today, please feel free to reach out to Terry directly. I'm sure she'd be happy to receive the comments and the feedback.
Absolutely.
And with that, you'll get an email from me next week about the future webinars. And everyone have a safe and enjoyable long weekend. And thanks again.
Thank you very much.
Thank you.
Cheers.
Bye.
Bye.
Bye.